As time goes on, we see more risk-taking, more of a departure from reality, a time in which nothing makes sense, but who cares, let's party. We're almost approaching 2020, and this is beginning to resonate from 100 years ago, the Roaring Twenties, a time in which the Fed opened the taps, the people felt the affluence, and everyone benefited and bathed in the infinite prosperity, except that was a dream turned nightmare. You came here for the truth, so let me unveil that for you. Today I have several economic indicators to show you. This is going to be one of those old school money GPS videos. I have so much to cover in one video. Let's get into it right away. The Fed is about to cut rates for the first time since 2008 as the trade issues weigh on growth. This is a topic that I have been covering over and over again. I just wanted to start the video off with this because it is already priced in. The market is feeling it. Is it going to be 25 basis points? Is it going to be 50 basis points? That seems to be the only question at this point here. We don't know what they will do, but you are seeing this information right now before it happens. If they actually go for that cut, we are going to see the markets rejoice as a result. A lot of it is already priced in. They are already expecting it and demanding it. So we'll see how it plays out. Will they suggest that 25 basis points is enough? Maybe they want 50 basis points. That wasn't enough and they're going to react negatively to it. I don't know, but we have to go back to the original statement I had made about this, is that if we are noting that the unemployment rate is really low, that things are really hot right now, why are we dropping rates? That's the question I have. Let's move on. Investment for growth has varied after the start of the Fed cutting cycles. Look at the previous instances. If you see the 90s, we see 95, 98. After their cuts, they begin to, of course, do well. However, if you look at this leading up to the previous cycles, it wasn't necessarily the case. It might be hard to see on this chart here, but essentially right in the center, we are looking at where that first Fed cut is and then the results afterwards. This is the index S&P 500 investment for growth, and you can see the breakdown there. I don't know what's going to happen, but if it's like the previous two cycles, it does not look good. Effective Fed rate and unemployment, comparing this to the previous recessions that we have seen time and time again, we are noting the exact same issues. If you look at the red circles here, that basically just depicts where we are at today. And of course, you can see that this isn't looking good because the Federal Reserve backed into a corner. They are now beginning their cutting cycle. That's the blue line. And you see the Fed funds rate. And this, of course, shows us we've got a problem on our hands. I want to make that very, very clear. Every single time that they do this, we end up in a recession. It's not because necessarily the Federal Reserve is cutting rates, but of course this is the effect regardless. You could see that this has happened not once, not twice, but it happens over and over and over again. This is a really good chart if you want to pause the video and take a look at it. You can see what I love to always pay attention to, Northman Trader, what he had to say. Central banks between 2009 and 2018. We will print 20 trillion and cut rates to nothing, and that will reach our inflation goals. Central banks 2019, okay, none of that worked, so let's print more and cut rates again. It's crazy, but this is what's happening. He said, trust us, we know what we're doing. People, of course, they don't have any other way to deal with it. They simply say, well, they know what they're doing. I'll just let them handle it. I'm going to keep investing and hope that they are willing to push this market higher. Even if it doesn't go that way, I'm just going to cross my fingers because I have no other options. That's the majority of people and what they have gotten themselves into. It's actually quite appalling. You're looking at another comment that he made here. Perspective, current U.S. stock market capitalization, 145% of GDP, peaked in 2017 at 154%. The previous two peaks came in at 146 and 137. All right, now if you see the chart down below, you are witnessing actually going beyond the real economy yet again. We are witnessing this because you can measure it in, for example, the total amount of debt. You can look at the GDP. You can look at the stock market, and you can try and analyze these on their own. But when you start comparing it to other metrics like the GDP, and yes, we know that all of these are manipulated, but even if you stay within those parameters, it is very telling, right? Looking at this shows us that we have gone and accelerated far beyond the real economy, and that is the truth. I'm going to show you some of the details that we look at all the time, like the PMIs and so on, that are weakening consistently. Look at the S&P 500 buybacks. I mean, it is crazy to see how bad this has become. And I say bad because if they were not there, the S&P would be significantly lower. If they were doing what India is doing right now and taxing the buybacks, I bet you it wouldn't be going this way. Previously, this was actually considered to be manipulation of the stock price. Apparently, that doesn't exist anymore. But here you go. This is where we're at. The buybacks going at an accelerated rate. And this is something that people need to understand. Two things. Number one is that in a recession, these companies will most likely not do buybacks or do much less of them. Number two is that you're going to find many of these companies are going to reduce their dividends, and that should be worrisome for a lot of people who intend on, well, I'll just hold off and I'll just wait, and then the stocks will eventually go back to where they were before. This wait and see mentality, people need to understand the business world and they need to open up to other asset classes. I think that they are missing out big time. The yield curve picture is sending a message that suggests this is no insurance cut. Now we're talking. This is part of Northman Trader's article that he wrote, and I wanted to show you this because when you see it all breaking down, when you look at the actual indicators that the Federal Reserve doesn't talk about, like the yield curve, it is very important because this has been a 100% perfect indicator. Now you see this time and time again where it goes out of control, you see the yield curve inversion, and then a recession happens. Now whether that happens 3 months later, a year and a half later, all it's doing is telling you that we have a cycle that's repeating. That's it. That's all I'm trying to point out, and I hope you see that. In this case here, we are noting something which I've mentioned previously, is that what we are being told is very different than what's actually happening, and I think this makes it very, very clear, at least to me. I'm sure it does to you as well. Record number of the fund managers in this survey are concerned about corporate leverage. This is a number that continues to increase since the financial crisis. This was not the case a few years ago, of course, but it has gone into this astronomical level at this point. We are watching year after year after year as there's just more leverage being used. And I see people laughing about it, how fantastic their gains have been because they've used leverage. Big mistake, of course, but you only see that when everything starts to come down. This is just, again, the yield curve spread showing you how this has persisted for the period of time throughout the financial crisis afterwards. It has basically been coming down in a straight line, and we are witnessing today what has happened 2000, 2007, repeated patterns over and over again. Weekly hours worked in the manufacturing sector in the United States, we have not seen a dip like this since the financial crisis. This just tells us that we are noticing the exact same things, the patterns appearing. This happens to be connected in with the PMIs, what we are noting in the actual real valuable economy, not with stock buybacks or some other garbage. When you look at the Eurozone yield curve spread, we are watching the exact same thing. Looking at, the last time I checked, by the way, we are now at $13.7 trillion worth of negative yielding debt globally. It is unbelievable. A lot of that coming out of the Eurozone, OECD growth, and the PMIs of the largest world economies. Take a look at this coming down yet again over the years. This is a number that will fluctuate, as you can see, but of course we are watching the same thing again and again. There are so many things that are just happening repeatedly, and we are watching this cycle coming to an end. Can the reducing of interest rates, can more money printing actually in fact do what they say they would love it to do, even though for the last 10 years it has not been the case. It has not been successful. Negative interest rates were not successful either. It is a failure, but at this point, they really don't have any other options. They're trying to instill confidence. At the same time, they are permanently destroying what they have. It is going to be insane as this system unravels. PMIs of small open economies and large economies, watch, around the world, same things are happening. The manufacturing, the exports, the imports, the slowdown. It's all happening now, not tomorrow, not the year after. We are watching this occur over and over again. Corporate profits with inventory valuation and capital consumption adjustment. They'll take a look at this. When they did their revisions, you could see that corporate profits, the red line, was revised significantly lower. How many times have I told you about revisions, whether it's coming from any of the government numbers that are coming out, the jobs numbers and so on? They're always revised down, but nobody pays attention to it. We are watching this to happen in basically all different industries, and unfortunately, most people, they don't care. They're not watching any of this. They are just looking at the basic facts that are outputted there by Jim Bear Stearns Kramer, and all of those out there speaking on the teleprompters, telling you what to think, telling you what is right. And unfortunately, for most people, they do very well for this stretch of period time, and they think everything is good, but ultimately it will be a very big burden on them when they're relying on their pension, when they're relying on their 401k, and we're going to see how that all plays out, that's for sure. If you found this video informative, then you got to hit that like button. What are you doing? Don't go anywhere. Click that one button. You're supporting this channel. I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. You can get all the details at the link in the description. Check it out if you want the audiobook that's available at themoneygps.com. If you want to know what's going on in the real economy, the real deal, then you got to watch this video. Definitely click on it, and I will see you there.